Welcome back. So let's continue with this topic on published, and I want us to look on the second component, and that is a statement of financial position. So a statement of financial position, which was formerly known as the balance sheet, is a statement of asset, liabilities, and equity or capital. So mean that this one is prepared by a company to ascertain its financial position at the end of the year. So a company will prepare this to know the asset it owns at the end of the year, what are its liabilities, and also what is the capital of the company, or basically what is the equity of the company at the end of the year. Equally, when a statement of financial position is being presented, is being prepared, it is prepared based on the famous accounting equation. The accounting equation states that assets are equal to what? Capital and what? And liability. So therefore, you can say that this is prepared to ascertain the financial position of an entity, as at the end of the year, as at the end of the year, as at the end of what? Of the year. So, and on the other hand, we have said that this one is prepared based on the accounting equation. So we can say it is prepared based on accounting equation, accounting equation. So when talk about the accounting equation, this is a fundamental equation in accounting, and the equation states that assets are equal to capital, but in a company, capital is known as equity plus the liabilities, So therefore, the statement of financial position is prepared based on that accounting equation, So that's why by the end of the day, we say that a statement of financial position has to balance. Your total, or the total asset of the company, must be equal to equity and what? And liabilities. And we can now look on the format. How do we present this? A statement of a financial position. So equally, assuming we are preparing this for a company which is called XYZ Company Limited, the first thing you should have always is the title, the name of what we are preparing. We are preparing a statement of financial what? Position. And this one is important to note that we prepare it as at the end of the year, because I've said that this is prepared to do what? To ascertain. That's what you have said here, is prepared to ascertain the financial position of an entity as at the end of the year. That's why you can see here, we are saying it is prepared as at the end of the year. So basically here, we always start with the asset. It's also important to note that asset here are classified into two categories, non-current asset and also what? The current asset. So what we start with here are the non-current asset. Non-current asset, this we know are those particular assets which are acquired by a company to help the company in terms of generating revenue, and two, they are assets which are expected to last in a business, to be used in a business for a period of more than one financial year. So this include property, plant, and equipment. And here we also use just a single column. You should have a single column here, not two. Property, plant and equipment. Property, plant and equipment now, I mentioned earlier on that this include all tangible and current asset. So all tangible or basically tangible and current asset of the company, including landed buildings, furniture and fixtures, motor vehicles, plant and machinery. We don't record them here separately, but rather what we do, you have to compute the net book value of all those tangible and current assets. You add the total net book value for those assets, and then you include the total here under the heading of the property, plant, and equipment. That is a requirement of IS1, that whenever the company is preparing, presenting a statement of financial position for publication purpose, tangible and current asset should not be recorded here separately, but get their total net book value at the end of the year, and then you include that here as what? Property, plant, and equipment. We also record intangible assets. Intangible assets. Intangible assets. So the intangible assets, these include things like patent, things like what? Copyright and so on. We also have the investment property. Investment property. Investment property, these include any land which is acquired by the company for it to appreciate, the company sell it in future, or any building which is constructed by the company for the company to lease it out to be earning what? Some rental income. So that is an investment property. And then we also have investments. Investment. This is investment in shares, investment in debt instrument, and mostly the investment which are included here as non-current asset are financial assets at fair value through other comprehensive income. So when talk about this financial asset essentially is investment in shares. Whenever the company has invested in shares and the company intends to retain ownership of those shares for a long period of time, then we refer to that as financial asset at fair value through other comprehensive what? Income, and basically that is a long-term investment. So therefore is an non-current what? Asset. Then from there we proceed and include or record now the current asset. The current asset. So when talk about the current asset here, we are talking of the assets which are related to the trading activities of the company. We are talking of things like inventory, the receivables, cash at hand, cash at bank, and so on. So what we include here, or the current asset include the closing inventory, the trade receivables, cash and bank balance, and also financial assets at fair value through profit and loss. In other terms, these are short-term investment. Short-term investment. So when talk about the short-term investment, this is where a company may invest in shares which are trading in the securities exchange market purely for speculation. The company is buying those shares hoping that the market price will increase in the near future. The company sell those particular shares and get a capital gain. So these are the non-current assets which we include here. And then from there, what we do here, we get the total assets. The total assets, of which now the total asset, you have to add non-current asset and also what? The current asset. Double underline, because that is the end of the first part. You have gotten the total asset, then we record equity and what? Liabilities. Equity and liabilities. We start with the equity, of which in this case, when talk about equity here, we are talking of the share capital of the company and reserves. And the reserves. That's what we record here. Equity, share capital, and what? Reserves. So therefore, what we record here will include the ordinary share capital, and now the reserves. The reserves include what? These include the retained profit of the company. In other terms, we also refer to this as the retained earnings. Retained earnings, share premium is still a reserve. We also have general reserves. General reserves. We also have revaluation reserves, reserves etc. So we include all those here, and then get the total figure which you get there. We refer to it as total equity. Total equity. So therefore, equity comprises of share capital and what? And reserves. Then from there, we proceed and record liabilities. Liabilities equal, we classify them into two categories, non-current liabilities and current. We always start with the non-current liabilities. Non-current liabilities. So non-current liabilities are basically these are long-term liabilities of the company. And these include things like the bank loan, things like debentures, or even bonds issued by the company to borrow money from the members of the public. This will also include something I mentioned earlier on, redeemable preference shares. Redeemable preference shares. If the preference shares issued by the company are redeemable, then we say this is like a form of a debt to the company, because these are preference shares. Once issued, the company has to redeem them. The company has to refund back the principal amount paid by the holder of these shares after a given period of time. That is a non-current liability, and that's why we said the dividends are part of the finance cost. Part of the finance what? Cost. And the other item which we also include here, deferred tax, liability, deferred tax liability. We also included there. So therefore, mostly those are some of the components of the non-current liabilities. And finally, we record the current liabilities. The current liabilities. So current liabilities, these are short-term financial obligations of the company. They include things like trade payables, the amount of money which is owed to the suppliers. Also something like a bank overdraft. Also the current tax. The current tax is the tax which was payable by the company during the current what? The current financial year. So those are some of the common items of the current liabilities. And then what we do finally here is that we get the total equity and liabilities. Total equity and liabilities. And basically whatever you get here is the total equity and liabilities, always that must be the same with the total asset. And basically that is in accordance with our accounting equation, which state asset are equal to equity plus what? Plus liability. So that's how we prepare the statement of financial position in accordance with what? In accordance with IAS 1. So I want us to proceed and look on the third component. Remember that is component number 2 of the published. So the third component, number 3 is the statement of changes. The statement of changes in equity. Statement of changes in equity or statement of changes in net assets. Statement of changes in net what? Asset. But the common name for this, the word which is commonly used even in an exam, in your exams, is the statement of changes in equity. But some books still use the word, the statement of changes in what? Net asset. What is this now? This is a component of a financial statement which is prepared to show or to explain the movement or the change in the items of equity. So what are equity? You have to remember equity comprises of the share capital and reserve. So therefore, this is a statement which is prepared by a company for the company to be able to explain why the items of equity changed. If the ordinary share capital of the company at the start was 20 million and at the end of the day is 50 million, why was that change? You can only be able to get that particular explanation from what you refer as a statement of changes in what? In equity. So that's why we are saying that this is prepared. This is prepared to explain the change, or movement, in the items of equity, So you have to remember equity comprises of what? Equity comprises of share capital. This comprises of ordinary share capital, and reserves. And what? Reserves. So these are now the items of equity: ordinary share capital, retained profit, share premium, general reserve, and also what? The revaluation reserve. So by going through that particular statement of changes in equity, you'll be in a position to understand why the items of equity changed during the current what? Year. So then from there we can proceed and look on the format. How do we prepare this? How do we prepare a statement of changes in equity? How do we prepare this statement of changes in equity? So when preparing this, a statement of changes in equity, So always we start with the details column, and then we have columns equal to the number of or to the items of equity the company had in a certain year. So therefore it's upon you to go through the information which are provided with by the examiner. You see which items of equity was that company having during that year, and then you have all those columns there. If the company had, for example, ordinary share capital, share premium, general reserve, retained profit, have those particular columns there. And then finally, you have the last column, which is what? The total column, column. So let's look on the format for this. So I've said we have a number of columns here. So always we start with what? With the details column. And then the common items of equity you'll come across in any question, or any company will be having, include ordinary share capital. So that is ordinary share capital in full. The other one is retained profit. Remember those these are the separate columns. These are separate columns. The other item here is share premium. A separate column. The other one is general reserves. And then we can have revaluation reserve. Reserves. And we have the last column here, which now will be the total. Column. So mostly those are the various items of equity you'll come across in any question. So what we start with when preparing this statement of changes in equity, we always start with the opening balances. Opening balances are the balances brought down. These are the balances of these items at the start of the year. At the start of what? Of the year. At the start of the year. And then before we adjust those opening balances with the transactions which occurred during the current financial year, there is something mostly which we adjust to the retained profit for the retained profit balance there called prior year adjustments. A prior year adjustment. Prior year adjustment. So when talk about the prior year adjustment, we are talking of those items of maybe expenses which were supposed to be taken or which were supposed to be taken into account in computing the profit of previous years, but were not taken into account. For example, you may be told that there were some bad debts which were supposed to be written off in the previous year, but they were not written off. So automatically, when preparing the income statement of the current financial year, those bad debts which relate to the previous year, you can't take them in your income statement, because we know in preparing the income statement for the current year, we only take into account the expenses and the incomes for the current year. So therefore, such a bad debt which was supposed to be written off in the previous year, it was not written off. What you do, you adjust it in the opening balance, the opening profit. So what you do, you come and you deduct that from the opening profit, the retained profit at the start, because that was supposed to be adjusted in the profit of the previous year. And then take that now to the last word column, and then now you take into account the transactions which occurred during the current financial year and which affected these items of equity. So some of the common items include something like a bonus issue. A bonus issue. Bonus issue, basically this is the issue of additional shares to the existing shareholders of the company free of charge, and the bonus issue are financed from the reserves. The company may make a bonus issue, finance that from either the share premium or the retained profit. So once you're given such a transaction in an exam, the examiner specifically will tell you which reserve was used by the company. So therefore, a bonus issue increases the ordinary share capital, and then the reserve which was used by the company to finance that bonus issue, if it is a retained profit, it reduces. If it is share premium, it do what? Reduces. Always will be given some instruction regarding that. Which reserve was used in terms of financing that bonus issue? Was it share premium or was it the retained what? Profit. So increase the ordinary share capital, and then you reduce the reserve which was used to finance that bonus what? Issue. So the other transaction which we also capture here is a right issue. A right issue is a basically issue of additional shares to the existing shareholders of the company at a discounted price to the market price, at a price which is below the market price. Mostly that affect the ordinary share capital and the share premium. And the share premium. Then take that to the last column. And then the other item is what? Which we also capture here is the profit for the year. The profit for the year, that should be taken to the retained profit column, and then we take it to the last column there. The other items which we also capture here are the dividends. The dividends, and specifically what we take into account here are the dividends which were paid, or in other terms, what we refer as interim dividends. Interim what? Dividends. It is important to note that proposed dividends, those particular dividends, we don't capture them here. This is something you need to know from company law, that dividends can only be deducted from the profit of the company once they have been declared for payment, once they have been approved for payment by the shareholders of the company. Because for the company to pay dividends, what is required in accordance with the company law is for the directors to recommend the payment of those dividends. Once they have been recommended for payment, then during the AGM, the shareholders will need to declare them, will need to approve the payment of the same. So once the dividends have been approved for payment by the shareholders of the company, that's the only time they become a liability to the company. But proposed dividends, we don't include them here. We don't include them, we don't deduct them from our profit, we only deduct the interim dividends, the dividends which were what? Which were paid. The other item which we may also capture here is a revaluation gain all what? Loss. Revaluation gain or what? Or loss. So the revaluation gain or loss, this whereby some items of PP were revalued upward or downward. So that affect the revaluation reserve. Again, we add it, and then a loss we do what? We less it. Again, we add, and then a loss we do what? We deduct. The last item which we capture there is any transfer to what? Any transfer to general reserve, transfer to general reserves. So a transfer to general reserve, this is an amount which is proposed by the directors to be transferred from the retained profit of the company to general what? Reserve. So what will happen is that the retained, assuming this this will be our first column for ordinary share capital, the retained profit column, the share premium, the general what? The general reserves, and then we have what else? What else do we have here? General reserves. We have revaluation reserves, and then the total, So transfer to general reserves, this amount of money which is transferred from the retained profit of the company to what? To general reserves. So the retained profit reduces, a general reserve will increase, and then no amount which is taken out to the total column there. And then what we do here, we get now the balances at the end of the year, balance carried down. And this balance carried down, this is now what we transfer to the statement of financial position. So when preparing the statement of financial position, all the items or these particular balances which we record there, actually we derive them all is what we will be having here as a closing what? Balances. So for the ordinary share capital, retained profit, share premium, general reserve, revaluation reserve, and the total. So these are basically now the figures which we transfer to our statement of what? Our statement of financial position. So basically that's how we prepare this statement of changes in equity statement of net asset. Mostly, once you come across a question from this particular topic, and which I mentioned is a compulsory question, in any question for, or in any paper for financial reporting and analysis, you will always come across a question from this particular word topic. So mostly once you come across a question from this topic, the examiner may require you to prepare the 3 component: statement of comprehensive income, statement of financial position, and statement of changes in equity, or you may be required just to prepare 2. The statement of comprehensive income and also the statement of financial what? Position. So before we look on an illustration, as far as this is concerned, I want us to mention something to do with the last component. Remember, we said statement of the statement of cash flows. We are going to cover on that as a separate topic. So before we look on an illustration, I want us to mention something to do with the notes. What are the notes, and what should be included in the notes to the financial what? Statement. So let's look on that as the last component before we look on an illustration question as far as this is concerned. So component number 4, and that is notes to financial statements. Note to financial statements. These are 4th component. So what are the notes to financial statements? So when talk about this or this note, we are talking of the supplementary notes. These are the additional notes which accompany the financial statements which have been prepared by the company. And the objective of this particular note here, 1, is to explain the accounting principles, the accounting concepts which were used by the company in terms of preparing financial statement. We know that when the company is preparing financial statement are prepared on certain accounting concept. These accounting concept includes things like what? They include what we refer as the going concern concept, the matching concept, the prudence concept, and so on. So therefore, this note will explain those accounting concepts used by the company in terms of preparing financial statement and also accounting policies. When talk about accounting policies, we are talking of, for example, how the company depreciated its asset, or the asset depreciated using straight line method, reducing balance method, and so on. So therefore, that is the objective of the note. So we can say that these are supplementary notes. These are supplementary notes notes to financial statement, full stop. They do what? They explain accounting concepts, used and accounting policies adopted in preparation of financial statements. Statements. So therefore, you have said that these are what? These are supplementary notes to financial statements. So what is the objective? The objective is to explain the accounting concepts used by an entity, and also accounting policies which were adopted in preparation of financial statement, financial statement. Now, what should be included in these particular notes? What should be included in these notes? So we can say they include a number of items. One, these notes include what we refer as the contingent asset and liabilities, So number two, these notes also include what we refer as the depreciation of assets, of which this particular note specifically will be explaining how the company depreciated asset, which accounting policy was the company depreciating asset using straight line method, reducing balance method. That's what the company will explain in the notes. They will also include what we refer as the accounting principles, or concept used by the company in terms of preparing financial statements. This particular note will also include what we refer as events after reporting date, So basically, these are events which occurs after the financial statements have been prepared, but they need to be brought to the attention of the shareholders. For example, the company acquired significant assets after the financial statements were prepared. That is an issue which automatically must be brought to the attention of the shareholders, and because it cannot be captured in the financial statement, so it should be part of the note. So here the company will also include information about maybe the employees' benefits, benefits. This note will also include what we refer as the accounting policies, other accounting policies used by or adopted by the company. For example, how the company was valuing its inventory. The company used the RIFO method, the FIFO method, and so on. So therefore, these are basically part of the items which will be included in the note to what we refer as the financial statement. You may come across a question in an exam whereby you're required to explain what are the notes to the financial statement, and equally what are the components of what should be contained in those particular notes. So those are basically some of the items which should be included in the notes now to the financial statement. Yes, so basically that's what you need to know as far as that is concerned. I want us to take a short break, and then we come back. We look on the question which was tested in the sitting of August 2023 as our illustration, because that question was requiring the preparation of three components: statement of comprehensive income, statement of financial position, statement of changes in what? Equity. So we do that after the short break.